Imagine waking up one morning to find your mortgage rate has doubled overnight. Or picture walking into your favorite coffee shop only to discover the price of your latte has skyrocketed. These aren't just random occurrences. They read the ripple effects of decisions made by powerful institutions that shape our financial lives every single day. I'm talking about central banks, and today we're rediving into the titans of monetary policy, the Federal Reserve and the European Central Bank. Welcome to the Economy Unpacked daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. Central banks are the puppet masters of our economic world, pulling strings that affect everything from your savings account to the global stock market. They control the supply of money and the cost of borrowing, which directly impacts your mortgage rates, credit card interest, job opportunities, and even the price of milk at your local grocery store. When inflation heats up, central banks raise interest rates, making loans more expensive and cooling down the economy. On the flip side, when things slow down, they cut rates to encourage borrowing and investment. In short, these institutions quietly shape our financial stability every single day. Now, when it comes to central banks, two heavyweights stand out: the Federal Reserve, Fed in the United States, and the European Central Bank, ECB. These financial powerhouses don't just influence their home turf. Their decisions send shockwaves across the globe. The FED's policies affect the US dollar, the world's reserve currency, while the ECB governs the euro, the second most traded currency. When either of these banks makes a move, stock markets from New York to Tokyo feel the tremors. Let's start by unpacking the Federal Reserve. Born in 1913 after a series of banking panics, the Fed is America's central bank. It's not your typical top-down organization. Instead, it's a network of 12 regional Federal Reserve banks spread across the country. With a board of governors calling the shots from Washington, D.C. This unique setup allows the Fed to balance national policy goals with the diverse economic realities of different regions. What sets the Fed apart is its dual mandate. Unlike many central banks that focus solely on keeping prices stable, the FED has two equally important goals: maintaining price stability and maximizing employment. This dual focus gives the Fed flexibility to pivot its strategy based on what the economy needs most. Sometimes it's all about fighting inflation, like during the stagflation era of the 1970s. Other times, such as after the 2008 financial crisis, the focus shifts to boosting job creation. Now, let's hop across the Atlantic to the European Central Bank. The ECB is a relative newcomer, established in 1998 to manage the euro, a currency shared by 20 countries in the Eurozone. Imagine trying to set one interest rate that works for economic powerhouses like Germany while also accommodating struggling economies like Greece. That's the tightrope the ECB walks every day. Unlike its American counterpart, the ECB has a laser focus on one primary goal: price stability. Its legal mandate is to keep inflation hovering around 2%, period. This singular mission is deeply rooted in Europe's painful history with hyperinflation. After both world wars, the ECB doesn't have an explicit mandate to maximize employment like the Fed does, which leads to some fundamental differences in how these two banks operate. Both the Fed and ECB have a toolkit for influencing the economy. They can adjust short-term interest rates, buy or sell government bonds, and in extreme cases, unleash the financial bazooka known as quantitative easing, QE, massive purchases of bonds to flood the economy with cash. but how they use these tools can differ dramatically. The Fed tends to move faster and more aggressively when crisis strikes. Like in 2008 or 2020, the Fed often acts swiftly, slashing rates and launching huge QE programs. The ECB, on the other hand, often moves more cautiously. It's constrained by the need to negotiate between member states with different economic needs, which can lead to criticism for being too slow during emergencies. These differences extend to how they approach their core missions. The Fed treats its 2% inflation target as more of a long-term average, allowing for periods of higher inflation if balanced out by lower inflation later. The ECB, however, sticks to its 2% target more rigidly. And when it comes to jobs, the Fed actively manages unemployment as part of its mandate. While the ECB leaves most of the heavy lifting on job creation to individual governments, these policy differences become stark during times of crisis. Take the 2008 financial meltdown. The Fed quickly slashed rates to near zero and launched an unprecedented QE program. The ECB, facing a debt crisis in several Eurozone countries, initially hesitated. It wasn't until 2012 that ECB President Mario Draghi made his famous "whatever it takes" speech, finally calming panicked markets. The actions of these central banks don't just stay within their borders. They ripple across the global economy. When the Fed raises interest rates, it typically strengthens the US dollar. This makes imports cheaper for Americans, but can hurt US exporters and trigger economic turmoil in emerging markets as investors rush to the safety of dollar-denominated assets. ECB policies, meanwhile, influence the strength of the euro, affecting everything from the competitiveness of European exports to the cost of your next vacation in Paris. Looking ahead, both banks face significant challenges. The Fed is walking a tightrope, trying to bring down inflation without tipping the economy into a recession. It's a delicate balance, made even trickier by the constant political pressure that comes with being America's central bank. The ECB faces a different kind of struggle. How to set one monetary policy that works for 20 diverse economies, an interest rate hike that might be perfect for booming Germany could spell disaster for debt-laden countries like Italy or Greece. It's like trying to find one-size-fits-all clothing for 20 people with wildly different body types. So, why should you care about all this central bank drama? Because understanding the differences between the Fed and ECB is crucial for making sense of the global economy. For investors, these policy differences can mean the difference between profit and loss in currency markets, stock portfolios, or commodity investments. For businesses, they impact everything from the cost of borrowing to international competitiveness. And for everyday people like you and me, central bank decisions influence our job prospects, the interest we pay on loans, and the returns we get on our savings. In the end, the Fed and ECB are two sides of the same coin, both striving for economic stability but taking different paths to get there. The FED, with its dual mandate and flexible approach, often acts as the world's de facto central bank. The ECB, focused solely on price stability, plays a crucial role in maintaining the euro's strength and the economic cohesion of the Eurozone. As we wrap up, I want to hear from you. Which approach do you think is more effective? The FED's flexibility or the ECB's laser focus on inflation? Drop your thoughts in the comments below. And if you found this deep dive into central banking helpful, hit that subscribe button and ring the bell to stay updated on all things finance and economics. Until next time, this is Economy Unpacked Daily, helping you make sense of the money that makes the world go round.